Hello. I want to thank everybody for being with us today. Welcome to the Q3 2021 Global Bitcoin Mining Data Review. We're going to talk about the results of the Bitcoin Mining Council's survey in Q3. And we also have a very exciting program today. After we review the survey results, we're going to have 8 presentations of 8 different topics in the Bitcoin mining industry from 8 executives from Bitcoin miners. And then we're going to have an interactive Q&A session with industry analysts. So I'm looking forward to it myself. So I'm glad you're here. So let's talk a little bit about what happened in Q3. As you know, in Q3, we had an extraordinary dislocation and restructuring of the Bitcoin mining network due to the Chinese exodus. And lots of the hash rate came offline, and then the hash rate redistributed itself. So it's been a very dynamic quarter. The Bitcoin Mining Council is a voluntary association of Bitcoin miners, and we all came together in order to educate the public and gather some insight about what's happening in the Bitcoin mining business and how we're using energy. And so the survey results you see today are from 29 different companies, and it represents about 33% of the network. So it's a pretty statistically significant sample. And these are the Bitcoin miners that are part of the Bitcoin Mining Council. You can see them here. Quite an assortment. So we'll start with the summary. Bitcoin mining. Bitcoin mining uses an inconsequential amount of energy in the world. The amount of energy that Bitcoin mining uses is a rounding error for every other major industry. And that's the first takeaway. The second big conclusion is Bitcoin mining is rapidly becoming more efficient. And this is not well appreciated by the mainstream and most of the marketplace, but it's extraordinary the effect to which this is a technology business. And the rate of change in this business is going to, I think, astound you all. And the third interesting conclusion of our survey is that Bitcoin mining is powered by a higher mix of sustainable energy than any country or any major industry. And so obviously Bitcoin energy usage is a football, and people spend a lot of time talking about it. But what we found is that Bitcoin mining is more sustainable than any other industry and is more sustainable than any other country's energy mix. And with that, let's go to the meat of the presentation. I've got about 8 slides here. First, just a quick review. The total energy usage in the world is about 154,000 terawatt hours. That's energy consumed. About 50,000 terawatt hours are lost due to inefficiency. 188 terawatt hours of energy, not electricity, it's less electricity. It's more like a third of that, maybe 66 terawatt hours of electricity, but 188 terawatt hours of energy is consumed by the Bitcoin mining grid on an annualized basis as of Q3. That's about the size of the energy consumption of the Bitcoin mining industry. And so you can see Bitcoin mining represents 12 basis points, 0.12% of energy consumption worldwide. And it represents about 38 basis points of the wasted energy in the world worldwide. It is, again, literally could be tucked into, a small rounding error. You might ask, well, if it's such a small amount, why is it always in the news? And the answer is because Bitcoin mining is the most transparent usage of energy in the world. It's the one thing that we have transparency to. We don't have to trust. We can verify energy usage in Bitcoin, just like we can verify the supply of Bitcoin. It is a very precise, modern 22nd century industry. It's leapfrogged the imprecision and the ambiguity of the 20th century. And I think that's why people like to focus on it. But as you can see in relative terms, it's small. If we compare the use of electricity in Bitcoin mining to the overall electricity use in the United States, which is another metric for us, you can see that of the 10,000 terawatt hours of electricity used, or the energy used to generate electricity in the US for the grid, 6,800 hours of that, 6,800 terawatt hours is lost. It's wasted. So using energy to produce electricity is in and of itself an inefficient activity. But 65% of the energy used to generate electricity in the US is lost or wasted, and Bitcoin mining consumes about 2.8% of the wasted energy. So Bitcoin mining is really recycling wasted energy, and it's rescuing stranded energy. And it's part of the solution to the problem of how do we get more efficient. But as you can see, if one's really focused upon energy efficiency, 99% of the solution is with the existing industries and existing applications. And Bitcoin mining is just a rapidly improving part of the solution. Let's take a look at Bitcoin mining energy use compared to countries. Well, that 188 terawatt hours is just a minuscule fraction of any major country's energy use. And you can see it here compared to the world, compared to China, compared to Brazil, compared to Iran. It's fairly minor. I mean, it's true that you can find the smallest country in the world and compare Bitcoin to it. But of course, if you were to compare the energy usage of any industry or any major application to the smallest country in the world, you could say reasonably that everything that we've ever invented that uses electricity uses more electricity than a small country, because small countries only use 0.1% of the energy in the world, and every major thing is more than 0.1%. Now here's the big headline. Global Bitcoin mining is the highest sustainable energy mix of any major country. What we found in the quarter is the BMC members are running about 65.9% sustainable, and the global Bitcoin mining industry is about 57.7% sustainable. So there is no country that's 57% sustainable, right? And you can see the range of them. But the United States is 31% sustainable energy, and Bitcoin mining is 57% sustainable energy. So Bitcoin energy usage is cleaner, it is greener already than any country. And why is that? Well, it's because you can actually move the Bitcoin miners to the renewable power source, and Bitcoin mining pairs well with renewable power sources. In fact, it's encouraged. Well, it turns out that Bitcoin mining is not just more sustainable than every country. Bitcoin mining is a more efficient use of energy, and it's a negligible use of energy compared to every other industry. You can see how much energy we use in residential buildings. 26,481 terawatt hours versus 188. And you can see road vehicles, you're talking about a factor of 100 more, 15,400 terawatt hours, in commercial buildings and trucks and military usage and air conditioning. So you can see every one of these major industries is a bigger user of energy. They're using less sustainable energy. And for the most part, they're 20th century industries that have moved down the technology learning curve, and their energy efficiency is improving only very slowly, very gradually. You're not seeing an extraordinary improvement in the energy efficiency of any of these applications. If I pick three on the right that are cute, you see Bitcoin mining uses a lot less energy than gold mining by a factor of 3 less. Bitcoin mining uses less energy than computer games, and Bitcoin mining uses less energy than holiday lights. And so again, sometimes people crowdsource Bitcoin mining energy usage and think it's a lot, but as you can see, it's not a lot compared to anything material that uses energy. It's only a lot compared to not using energy at all. Now here's the cool quarterly results. I'm really excited about this. This is extraordinary. In Q3, we all know the hash rate increased. In fact, the hash rate jumped 48%. Okay, well, if Bitcoin mining was a complete energy intensive business, then you would think the energy usage would increase by 48%. But it didn't. The hash rate increased by 48%. The energy consumption, or in this case, the electricity consumption, increased by 21%. A very nonlinear result. Now, how do you explain that? How is it possible that electricity only increased by 21%, but the hash rate increased by 48%? And here the answer is mining efficiency. The actual joules per terahash, or in this case, the petahash per megawatt, which is the measure of efficiency that we chose to represent here, it increased 23% quarter over quarter. Now, have you ever heard of a company growing 23% quarter over quarter? Right? That means that you double every 3 quarters, right? This is hyper growth. The Bitcoin mining industry is getting hyper efficient. It was 23% more efficient in Q3. We ran 17.7 petahash per megawatt instead of Q2, which was 14.4 petahash per megawatt. And you can see that that's a big upgrade from Q1, where we were running at 12.6 petahash per megawatt. So as you can see, a very popular narrative is that Bitcoin mining energy usage is increasing. It's not clear that it is increasing. In fact, it's not even clear that we're maxed. We may have actually used more energy in the past than we are using now, because the equipment that we used to use and the efficiency of the mining centers was much lower. Now, you can see in the lower left corner, the Bitcoin Mining Council on average runs with an efficiency of 21.9 petahash per megawatt, right? The BMC members are running very modern equipment, well-engineered Bitcoin mining centers. They're well capitalized, and they're running more efficiently than the rest of the world. As they grow and as the rest of the world upgrades, of course, you can imagine the efficiency will continue to grow. If we look on the right side, in addition to the mining efficiency growing by 23%, the other really big headline result of Q3 was that the sustainable electricity mix increased by 3% quarter over quarter. And again, that's pretty aggressive. When you think there's only 100%, you can go to 0 to 100%. Right. And we're moving up 3%, and we're nudging up the overall number from 56 to 57.7%. So that was really quite compelling result. The BMC number for the BMC survey of 33% of the network is 65.9%. So of course, again, the BMC miners are leading the way. But what you see here is an industry that is rapidly getting more efficient and is progressively rotating to more sustainable energy sources. What's the explanation for that? Well, we know that a lot of fossil fuels were used to generate hash rate in China, and a lot of old equipment was used to generate hash rate in China. And a lot of inefficiently mined mining centers were used to generate hash rate in China. After the exodus and the crackdown, the antiquated mining centers went offline, the antiquated equipment went offline. And as the miners relocate, all of the capital is being aligned with sustainable energy. And so the well-capitalized BMC miners and the well-capitalized North American miners are actually bringing on disproportionate amounts of modern equipment with a higher hash rate, with a higher efficiency, with a higher sustainability. And you can see it right here in the numbers. Let's come back to this technology issue. What's really driving technical efficiency and energy efficiency? Well, I think it's really important to keep in mind, Bitcoin mining is a technology intensive industry. It has increased 42x in energy efficiency over just 8 years. 42x, 4,237% improvement in efficiency. If you track just mining efficiency, which means joules per terahash, right? The energy efficiency of the miners is 42x better. Now, how could that be? Well, the chart on my left kind of illustrates what's going on here. You can see, if you go back to January of 2009, CPU mining ran at 877,000 joules per terahash. Okay, we were basically using energy, almost burning energy to create hash rate. It was a very labor intensive, energy intensive business. And just like with all technology businesses, you go from labor intensive to some machines, to better machines, to better machines. So you can see the GPU jump was dramatic. And then we moved into ASICs by January 2013. And those first ASICs were 9,351 joules per terahash. And we made it down all the way to 1,250 joules per terahash by December of 2013. So a 700x improvement in the first epoch, the first 4 years, 13x improvement in the next 4 years, 3x improvement in the next 4 years. And, you can see clearly that this is semiconductor technology advancing. We're not really accounting for engineering advances like immersion cooling or better design of the mining centers. But what you can see here is a first order driver of technology is just these miners. And you can see and imagine what happens next. If the entire network moved to these S19s that run at 29.5 joules per terahash, then coming back to this chart on mining efficiency, the mining efficiency would go from 17.7 petahash per megawatt to almost double that, like 33. And so all you have to do is just upgrade the mining rigs to the modern generation, and you would double the efficiency of the network. And that's happening. Now, how do you might say, well, it costs a lot of money to do that. Well, there's a lot of capital flowing in the space. But then the other key point is this mining equipment is depreciating, and over 4 to 6 years, it's burning out. So if you keep using 4, 5, 6-year-old mining equipment, it's got a useful life. Maybe you can stretch it for 8 years, but maybe you can't. Time is naturally upgrading the network. And if money and capital doesn't do it, then just the natural depreciation cycle of the mining equipment does. And so it's an important other finding. Now, what are our conclusions from the survey data and from the technology? Well, we took a survey of all the Bitcoin miners to figure out what kind of energy they're using, how sustainable it is, and how efficient their mining operations are. And I've just presented that to you. But we also took a survey of the Bitcoin Mining Advisory Board, and we asked them for their estimates of how rapidly the equipment will improve over the next 4 years and over the next 8 years, the next epoch, and then the time period from year 5 to year 8. And the consensus of the Bitcoin Mining Council is that the technical efficiency of the ASICs is going to improve by a factor of 3x in 4 years, and then 2x 4 years after that. So if you look out 8 years, we'll be 6x more technically efficient than we are today, right? And that's pretty profound. That means we'll generate 6 times as much hash rate without any additional energy. The second important point to make is that Satoshi's protocol calls to cut in half the block rewards every 4 years. And what that means is that in a mining industry where the great majority of the revenue comes from block rewards, I mean, far in excess of 90% right now, 98%. It's anywhere from 90 to 98%, depending upon transactions. And since the Lightning Network came on, the transaction fees have fallen. The block rewards have become substantially all of the revenue. The network is scale, but what that means is that as the block rewards are cut in half, the budget to burn energy is cut in half. And so if you bear with me for the simple thought experiment, if the Bitcoin price holds constant for the next 20 years, then Bitcoin mining revenue will go from 20 billion a year to 10 billion a year in 4 years, to 5 billion a year in 8 years, to 2.5 billion a year in 12 years, to 1.2 billion a year in 16 years, and to 500 million a year in 20 years. So you can see the protocol naturally will reduce the energy consumption that is allowed, and you would end up with $20 billion securing a $1.2 trillion network, turning into $1 billion securing a $1.2 trillion network, turning into $500 million securing a $1.2 trillion network. So you can see the energy efficiency or the economic efficiency of the network is guaranteed to improve 2x every 4 years just because of this. Now, if you apply the rule of 72, then you quickly calculate that that means that the network is getting 18% more efficient per the protocol, even without improvements in semiconductor technology or engineering technology. For those of you who follow my Twitter, you know that today, Riot posted a large mining center, a very large scale mining center, and talked about 200 megawatts of industrial grade immersion cooling. So imagine large mining centers with immersion cooling with extremely efficient equipment, and then combine that with Satoshi's protocol of 18% improvement every single year in terms of economic and energy efficiency. And you can conclude that the network's going to get 18 to 36% better every single year for the foreseeable future. And hence the conclusion. Bitcoin mining is guaranteed to be dramatically more energy efficient in the next 8 years. And if I were to tell you that the airline industry is going to fly the same number of flights for the next 10 years, but is going to reduce its jet fuel usage 18% a year, you would say that's impossible. And if I were to say the train or the plane or any industry is going to reduce their energy consumption 18% a year every year for the foreseeable future, you would say that's impossible. They don't have a plan to do that. But in fact, what I can tell you with regard to Bitcoin is not only is Bitcoin going to get 18% more economically efficient and energy efficient every year for the foreseeable future, it's going to get more than that. It's going to do double that. It could do triple that. And that's just because the power of the protocol combined with the power of semiconductor advances, combined with the power of engineering and human ingenuity, makes for a rapidly evolving business, which is a technology business. And clearly, the Bitcoin miners that do the best engineering, that can bring together capital with engineering techniques like immersion cooling and industrial grade facilities, and then put that together with the most modern ASIC semiconductor technology that generate the highest hash rate in the most energy efficient fashion, those miners are going to take a larger amount, part of the hash rate. They're going to drive up the hash rate, and they're going to drive inefficient miners and antiquated miners and energy inefficient miners off the network. And so this is a self-cleansing, self-improving, very Darwinian, very competitive industry. And with that, I'm honored to actually work with 29 of the best Bitcoin miners in the world. And I would love to actually introduce you to all 29, but I can't do that today. So what I did do is I arranged to have 8 of them here to present to you. And they're going to each cover a different topic. So I would like to invite up on the stage Peter Wall. Peter's going to talk to us about Bitcoin mining and Texas and give us an update.
Awesome. Thank you, Michael. Thanks for organizing this and inviting everyone to speak. So yeah, I'm going to, I'm the first of 8 different CEOs to talk from various miners. Happy to go first. I guess the A from Argo is useful. I think kind of coming out of what Michael's talking, and this will just be 5 minutes from each of us. Michael's talking about, energy efficiency. I'm going to kind of carry on from there and talk about Bitcoin mining in Texas. And one of the main reasons why a lot of Bitcoin miners are heading to Texas, which is incentivizing renewables and stranded power. It's a big part of the story. It's a big part of why Bitcoin mining is a good use of energy. And it's a big part of why folks are moving to Texas. So as Michael said early, a little bit earlier, Riot is setting up in Texas. They just announced the 200 megawatts. We're also building, if you're not familiar with Argo, we're also building a project in Texas, a 200 megawatt mining center. So we're a publicly traded miner, originally in London, now both in London and on the NASDAQ. We mine in Canada and in the US. And this is actually a photo from close to our mine in Dickens County, Texas, where we're setting up our 200 megawatt facility in West Texas. So why Texas? Why is Texas becoming such a big hotspot for Bitcoin mining in North America? Well, first, what's going on? There is 6 large-scale mining operations at a minimum that are going up in Texas or that are already up, and over 20 small-scale mines that have been built out. So Texas is now accounting, as of today, for about 14% of Bitcoin's total network hash rate, which is a remarkable number, considering a few years ago there was very little Bitcoin mining in Texas. There is currently estimated a total of about 1 gigawatt of mining in Texas. And by 2025, there will be an estimated 5 gigawatts of power. So 5 gigawatts is 5,000 megawatts of power. To give you a sense of how much power that is, the town of Lubbock in West Texas, which is about an hour from where we're setting up, uses 400 megawatts of power. So that's, over 10 times the amount of power that, and Lubbock has a population of 200,000 people. So that's, just a sense of how much power Bitcoin mining is going to be using in Texas in the coming years. All of this is part of this hash rate migration from China to North America in particular. Obviously, there's other parts of the world where that hash rate has been migrating to, but it's meant that the most recent estimate is that there's now 35% of the world's Bitcoin mining hash rate in the United States and another 10% in Canada. So almost 50% of the world's Bitcoin mining hash rate is now in North America, which again is remarkable and is not something that, would have been predicted 6 months ago. Even a year ago when we were talking about, when journalists were calling me and asking about, this hash rate migration, this rumored hash rate migration, a lot of us remember those stories about folks, hash rate moving out of China. Prior to the Bitcoin mining ban, it was really just a rumor. And now it's a reality. And obviously a big, one of the big winners in that migration is Texas. So why Texas? Why are folks moving like us moving to Texas? The answer is low cost power. It has, some of the, if not the lowest, some of the lowest cost power in the United States. There's also free market incentives for wind and solar renewable energy. And a huge portion of the power in Texas is renewable. That's a big part of why we've moved to Texas and set up in Texas is to be able to tap into that renewable power. So in terms of what that looks like today, 23 gigawatts of renewables are currently online in Texas. That's wind and solar. And there's another 10 gigawatts that are coming online in the next few years. It's mostly solar that's coming. There's still wind going up. It's mostly wind that is already there. but there's more and more solar that is coming online. The total Texas grid, depending on the day and the time of year and how much generation uses about 80 gigawatts. So you're looking at about 25% now of power in Texas coming from renewables. And then obviously Texas is a super business friendly environment. We'll talk about that on the last slide of my presentation. But it's been very welcoming to the cryptocurrency community. So a little bit about the Texas grid and what makes it so unique. It's managed primarily by a group called ERCOT. It's not all ERCOT, but the vast majority of the Texas grid is ERCOT. It's not connected to the rest of the United States. So the power that's generated in Texas needs to be used in Texas. And managing the generation that's coming from power providers, power producers in Texas, and the load that is using it is a challenge. You need to make sure that you have a steady base load. And then you're able, when that load goes up during hot days or during times of peak demand, on cooler days in the winter, you're able to have enough generation to fulfill that load. So in order to help get that balance right, the ERCOT folks offer these ancillary programs, which are called load response, and they allow miners to be load balancers. But the most popular is controlled load response, CLR, and basically miners then use power when power is when it's not in short demand, when there's lots of generation going on, and then during scarcity events or peak demand, miners shut down and give power, at least part of their facility, sometimes all of their facility, and give power back to the grid. So kind of act as a reverse power station. And this really does balance the load. If you talk to ERCOT executives in Texas about the opportunity that miners are engaging in now, they're excited. They believe that this type of load balance, this kind of unique ability that miners have to shut down quickly and to give power back to the grid, can really add some stability and resiliency to the grid. They think that it's an excellent addition to the overall grid in Texas. Even politicians. We were at the Texas blockchain conference 2 weeks ago. Ted Cruz got up and spoke very intelligently and eloquently on this exact topic about how miners can be this load balancing, can provide this load balancing solution to the grid. So it's not just energy folks, it's not just miners, but there's also politicians who are also involved. And then lastly, this kind of load balancing also provides free market incentives for renewable, because wind and solar producers have a more reliable load that they know they can tap into, that they know that is there, so that they're not, shutting off their generating stations, shutting off their turbines when there's not enough load. They're able to sell their power. Even if it's at a low price, they know that they have a constant price that they're able to get. And so that's a really key part. It's very hard to store energy these days. And so for miners to be able to use that energy in a predictable way is really important for the grid. So just lastly on the politicians piece, a number of Bitcoin miners met with Governor Abbott in Texas 2 weeks ago. We had one of our team members was there, and so the governor is also very supportive of Bitcoin mining in Texas. He did say Texas is Bitcoin country, and that's you're going to hear that a lot in the coming years. All right, that is my presentation. Michael, back to you.
Great. Go Texas. Ben from Bitfarms is now going to give us a briefing on Bitcoin mining and institutional investors. Ben, take it away.
Thanks, Michael. So my name is Ben Gagnon. I'm the Chief Mining Officer at Bitfarms, one of the largest and oldest publicly traded Bitcoin mining companies in North America. Currently operating 6 Bitcoin mining farms in Quebec, Canada, and expanding internationally. In addition to operating granted our corporate hash rate, we are fielding calls on basically a daily basis from institutional investors. For investors, I think they're faced with cheap liquidity, unpredictable regulatory, labor, and operating environments as a result of global responses to COVID. And so Bitcoin exposure really is quickly changing from an interesting idea to a necessity, and is now less a question of if as to how. Over the past 12 months, we've seen as Bitcoin began its bull run, institutional investors have been flocking to Bitcoin in droves, and more specifically, they've been flocking to public proxies like Michael's MicroStrategy or Tesla, Square, and Grayscale. And those provided them with easy exposure to Bitcoin in their portfolios without obviously the burdens and the risks and costs of acquiring and holding Bitcoin directly. Well, this has done wonders for both institutional investors in Bitcoins as it opened up Bitcoin to new markets and investors. But now we see that investors are looking for more derivative investments into Bitcoin, and they're getting more comfortable with having it in their portfolio. They're getting comfortable with what I call the securitized Bitcoin layer, and they're looking for other forms of Bitcoin exposure. And this is where the public miners are coming in. While the public codes that I mentioned earlier have accumulated large Bitcoin positions, the public miners like Bitfarms have relatively much smaller Bitcoin positions, but are generating consistent and predictable daily cash flows of new Bitcoins for costs significantly below market value. And this year, we've seen a radical shift in market sentiment amongst most of the publicly traded miners. For the first time ever, most of the publicly traded miners have elected to hold on to most, if not all, of their newly mined Bitcoins, resulting in effectively daily accumulation of Bitcoin significantly below market values. And so the institutional investors that we speak to really love Bitcoin mining because it's a forecastable Bitcoin denominated cash flow for them. And it's very hard to find a cash flow that's going to be denominated in an asset where the price is increasing so predictably over time. So we're not reliant on any customers. We're not reliant really on any market events. And these Bitcoin denominated cash flows that we're generating on miners are subject to significantly less volatility than short-term Bitcoin price movements. And so we see all these investors looking at this daily accumulation of Bitcoin as somehow both a risk mitigator, because for miners, if the price pulls back, that's just a temporary pullback in Bitcoin price. It doesn't affect our operations. We're still producing the same amount of Bitcoins. We're still producing them for the same costs. Really, it just means that we have lower margins and a different price when we enter those Bitcoins into our books. But we still maintain all of that long-term exposure to Bitcoin price as it goes up. And at the same time, that growing stack of Bitcoin is functioning as an exponential lever on the Bitcoin, because it's an amount of Bitcoin that's growing on a daily basis. So as we have, approximately 2,500 Bitcoin in custody now, we're adding 10 Bitcoin every single day, and over the course of a year, these Bitcoin inventories can go significantly up in relative percentages, even if the Bitcoin price stays still. And if the Bitcoin price continues to grow, then you're going to have those leverage outsized returns. So really interesting space, I think, for institutional investors now, and a lot of derivative options for them to get exposure. And Bitcoin mining seems to be just one of the latest and greatest options for them to achieve yield in a really crazy and unpredictable environment.
Okay, thanks, Ben.
Thanks, Michael.
Awesome. So next up is Roman to talk to us about layer 2 scaling.
Thank you, Michael. Hello, everyone. My name is Roman Nouzaret from CCU.ai. We are a Bitcoin mining company that I co-founded in 2017 from Quebec, and that is now publicly listed on the TSXV in Canada under the ticker SATO. Today, the BMC members, Michael and I, would like to talk about the Lightning Network and the impact it will have on our industry, and how it can help people to use Bitcoin in a manner that reduces its environmental impact. As you all know, the Lightning Network is an instant and almost free transaction layer built on top of the layer on the Bitcoin blockchain. It is fully, sorry, I'm going to share my screen. It is fully decentralized. It works instantly around the world, and it requires very low levels of energy to work. In development since 2015, the Lightning Network is rapidly scaling, both in terms of technology and size. The number of Bitcoins locked in the Lightning Network doubled during the last 4 months of the year, and the number of nodes also doubled since early 2021. The Lightning Network brings new growth opportunities for our industry, particularly because it is ultra scalable, fast as light and almost free, secure and secured by the main chain and by the value of the Bitcoin price itself. It is also economically viable as it creates new revenue streams for miners, node runners, or any new applications built with it. More importantly, it all comes with another negligible energy consumption. What I'm talking about today is already a reality in San Salvador, where you can buy a cheeseburger for a few Satoshis or pay for your rent with your Bitcoins. But it is also seeing a major global technology adoption. The best example is Twitter Tips, which allows Twitter users to show their appreciation by sending fractions of Bitcoins as tips. The fact that tech pioneers like Jack Dorsey are implementing Bitcoin into their flagship products shows just how much of technology business Bitcoin is becoming. As the Lightning Network develops, it proves that the Bitcoin is perfectly placed to expand its functionality and use cases over the time, fulfilling in that way its original concept of a peer-to-peer electronic cash system. Thank you. Back to you, Mike.
Thanks. Okay, so now we have Forenzo, who's going to talk to us about Bitcoin mining in Europe. So take it away.
Thank you very much, Michael. It's a great pleasure. So my name is Fiorenzo Manganiello, and I'm the co-founder of Kowa Mining, which is today one of the leading blockchain company and Bitcoin mining company in Europe. I think, Michael, to connect to what you said in the early beginning of this conversation, so we have seen this huge flow of definitely of miners going from China, this hash rate moving from China to the US, but actually, clearly today there is a huge concentration and you will see obviously the growth of those large mining companies in the US and in Canada. So actually what we're trying to build and what we see it's extremely important for the future of decentralization of the Bitcoin network is to clearly have Europe as a competitive advantage, a competitive edge against clearly also the US power. So today, we control at least 11% of the European hash rate, which actually today it's around 8% of the world hash rate. So it's still pretty low proportion of the global hash rate. And we really need to believe and to think that actually Nordic countries and basically Norway and Sweden represent a clear opportunity for miners because, it's literally a long-term benefits of using countries like Norway and Sweden for their attractive energy prices, first of all. But the second is for sure for the abundance of energy, of renewable energy that those countries has. So to give you an idea, for example, we are strongly mining in Norway and in Sweden. I know we're reaching price of $30 per megawatt hour. The idea is also that clearly, what we see over there is that the regulatory environment is pretty attractive. And we got a lot of inbounds from companies all around the world to build data center there, but there is a lot of barrier to entry. So it's not so easy as to scale up in the US, where obviously you have large opportunities to run and build hundreds of megawatts like Riot's, for example, is doing. Clearly in the Nordics, you have barrier to entry, you have a lot of regulatory issue. You need to deal with local municipality. So obviously the timeline and the scale up across those countries is definitely less of advantage. But clearly today, Michael, when you discuss about the long-term efficiency of the Bitcoin protocol, we see extremely important to be there. And again, even if it's not, I would say, immediate scale up, it's long-term scale up for the network that in our view, it's also bringing this additional decentralization to the world network, which, in our opinion today is growing massively in the US, but today still in Europe, it's at early stage adoption. So, what we're trying to build at Kowa and what we also inviting also other mining company worldwide to do is definitely to consider Europe as a great opportunity to build data center over there and to help us in the decentralization process of the Bitcoin. Thank you very much, Michael. Back to you.
Awesome. Sheldon. Sheldon, you're up next. Tell us about regulation and Bitcoin adoption.
Thank you so much for having me, Michael. Yes, so my name is Sheldon Bennett. I am the CEO of DMG Blockchain Solutions. We are based in Vancouver, Canada. We also operate our Bitcoin mining operations in Canada, in the province of British Columbia. And we are blessed with all sustainable energy as we work off of large-scale hydropower. I first got involved in Bitcoin back in 2010. I worked for a company called Cisco Systems, and a bunch of our engineers were playing around with this idea of Bitcoin and mining Bitcoin way back with CPUs and GPUs, as we saw earlier in the presentation from Michael. But later on, a few years later on, I got involved with another company back in 2013 and 14, looking at growing larger Bitcoin operations centered in Canada. And over my years of working with them, I ended up starting my own company with a few of my friends called DMG as a private company. But in 2018, we went public, and we were publicly traded on the TSX Venture Exchange. But regulation is a really a big issue for myself. In my past, before Cisco, I worked in the accounting firms of PwC and Ernst & Young. And, I learned early on in the banking and finance practice why regulation is important. I went through Enron, I went through SOX, and all of these things of why regulation is good. And so I want to talk a little bit of history of Bitcoin real quick. I only get 5 minutes. And then I wanted to go into, what's going to happen and why it's good for us. So, when you look at the history of Bitcoin, it started back in 2009. It started with really a checkered past. And what I mean by that is you had this mysterious Satoshi Nakamoto and all the films and all the intrigue about who he is and how this whole thing started. Then you had this, years of negative press around Bitcoin with Silk Road. And then you had the fallout of Mt. Gox and later the NEM hack. And then we had, what I call, the retail crash of Bitcoin in late 2017, early 2018, which brought us into crypto winter. And I'm saying a lot of bad things. You think for a Bitcoin mining council, I shouldn't be bringing up all this stuff, but I'll tell you why I'm bringing it all up. And then today, after crypto winter and things are getting better for Bitcoin miners in the Bitcoin industry, we still have the economic uncertainty with COVID and hyperinflation and all the printing of money. And out of all of this, Bitcoin has been resilient. So it's continued to grow. It's very strong. Its usership grows, transactions grow. And, why does that happen? Well, I think there's two real reasons. One is that there's a core group of people that really believe in it. And I think we're represented here right now as this core group of people that believe in Bitcoin. And outside of us, there's also this idea that, it works. The protocol works. It does what it's supposed to do. And it's doing it very well. And as Michael showed earlier, is doing it very efficiently when you start looking at other industries out there and the economic value they bring. So when you think about all of this, you kind of go, okay, well, we've got a great thing here. We've got a protocol that works. We've got a group that really likes it. So what's going on in the size of how it's going to grow and what it's going to do? So you look at Bitcoin and you go, okay, well, it's overcome sort of its historical negative publicity. It's in the process, I believe, of overcoming its new sort of political issues or public issues on ESG, and I think this council is leading this. And it continues to outperform pretty much any other asset in the market, even though it's one of the most volatile. So it's there were press releases earlier in the year about Bitcoin mining being the most profitable business on the planet. And so it says a lot about the resilience of Bitcoin and why it's great. So getting back to, where's it going and what's happening with regulation? Well, when you look at Bitcoin and you look at its early stage as an asset, and you look at the fact that it's just now really being looked at from a government regulation point of view, and you look at, people trying to figure out what to do with it, you go back to, well, what was one of the other assets out there that went through regulation and what happened to it? And so I was just sort of thinking back, everybody says Bitcoin is similar to gold. And I was thinking back to the first gold ETF. That was back in November 1st, 2004. And at that time, gold had a price of $420 an ounce. And since then, many ETFs have grown, but since then, gold has never gone below $420 an ounce. And generally it's up over 300%. And so this is, a great thing when you look at this idea that gold went through a regulatory process where it now has multiple ETFs and it can be traded and bought and sold by virtually anyone on the planet that has an interest in gold. So, you look at what's just happened in the US with the first Bitcoin ETF being approved and money coming along. You see this as a sign of regulatory bodies getting comfortable with this new asset class. And this is really important because when you think about this asset class of Bitcoin, when you go back to 2009 and all these things I was saying about the bad publicity and the bad things about it, it's so resilient. It's proven itself over and over that it is a future asset that is going to be around for a long time. It's proving itself that it complies with regulations. It's proving itself that it is a trusted sort of technology, and it's continuing onward through regulation to prove itself to hopefully new consumers that it is going to be an asset class that they want to put in their portfolio. So, as someone that works in Bitcoin, as a miner and as a software developer, I see that we as sort of the leading companies in crypto, it's kind of our responsibility to help regulators understand what this asset is, how it works, help them develop regulations, get involved in the regulation process. Bitcoin Mining Council has done a lot of lobbying to help people understand what Bitcoin is and why it's valuable and why it's doing a great thing for the economy. If you really believe that Bitcoin is the future, like we do, then as I said many times in the past, the more mass adoption we can get into Bitcoin, the higher adoption rate we'll get, and this can only happen with regulation. Financial institutions are not going to allow an asset class to be sold and bought by their customers unless it meets all the regulatory issues that they would have for any other asset class. And so it should be our goal to help regulators understand this asset and bring it to the forefront. And you're seeing that we're doing this, and I think we're going to continue to do this. I have one slide that I could present if I have enough time, Michael.
60 seconds.
Okay, so I've always said in the past that I own Bitcoin, my kids own Bitcoin. My mom and dad don't own any Bitcoin, and they don't because they don't understand it, and they wouldn't know what to do. But if their bank offered it, they would own Bitcoin, and many people would. And so one thing I see for anybody in the Bitcoin ecosystem is this little slide I've used before, where if we can get regulation to understand Bitcoin, there's a huge opportunity for the whole industry. So Bitcoin mining is just one part of a massive industry that's growing. And that's going to continue to grow and grow and grow and grow as long as the regulatory bodies can protect all the users of the financial system. And this should be the goal for everyone, and everybody will win, and Bitcoin will become what we want it to be. I don't know if you saw my slide there.
Okay. Well, it's a great week for Bitcoin regulation. I think the ETF was a big win, and everybody's really happy about that. And you can see the market reacting. So next up, Jamie, tell us about Bitcoin and capital markets.
Happy to, Michael. Thanks so much for having me. So I'm Jamie Leverton. I'm the CEO of Hut 8 Mining. We have been around and publicly traded since early 2018. Our mining operations are located all in the province of Alberta. And I did want to give a shout out to my friend Peter, who did an amazing job of explaining the load balancing technology that we also take advantage of in the province of Alberta. Very similar to what they're now doing in Texas, which I just think is such an incredibly important and overlooked aspect of the Bitcoin opportunity here, to be a stabilizer for the grid, a stable off taker, and really continue to drive more renewable consumption into the grid. So much appreciated for that, Peter. We are headquartered in Toronto, and we trade on the Toronto Stock Exchange. We originally came onto the Toronto Venture, and then were moved up to the big board, as we say, about a year ago. And then this past June, we also dual listed onto the NASDAQ, where we sit on the global select tier. And what's really interesting about those two items, that being on the tiers that we are, we did that very strategically because we had a view that over time, more and more large institutions, longer funds would start coming into this space, and they would be looking for exposure that was available to them on the tier, on those types of exchanges and tiers. And so we made a concerted effort to do that, and we certainly have seen that pay off in both the liquidity that we've seen in our stocks since moving up to the NASDAQ, and the types of institutions that we're now seeing play in this space. And that was certainly most apparent in our last raise. So this quarter, we were able to do a common only raise in September of just over 172 million USD. And that was the first raise of quantum in this space that was done common only. Historically, we've seen deals in this space either be executed through ATMs or with some sort of a warrant structure in place. And that's really because the primary investors in Bitcoin miners historically were coming from retail and coming from hedge funds. But as this space has become more widely accepted, and we see more institutions coming into this space and looking for miners as a proxy to Bitcoin and as a way to get alpha, we've certainly seen that investor base expand in a very meaningful way, and certainly we believe this is the sign of more to come, and is a great thing for all of the publicly traded miners in the industry. The other thank you I would like to give is to Ben Gagnon. Ben talked about the hodling that most of the publicly traded miners are now doing. Hut 8's been hodling since our inception, and are proud to have kind of the largest amount of self-mined Bitcoin on our balance sheet as a result, with just over 4,700 Bitcoin on balance sheet. But really, this is the ability for publicly traded miners to now hodl is directly attributable to our ability to raise capital. Historically, we had, even Hut 8 had to sell the majority of Bitcoin that we mined in order to pay for our ongoing operations and to pay for the expansion of our operations, because access to low-cost capital at scale was very, very difficult to come by. But now we see, again, more and more capital coming and being put to work in this space, which is allowing for more and more hodling of Bitcoin, which is good for the industry, good for the miners, and ultimately good for the investors. So that's been a very significant shift as well. And just the last note I will make with respect to the changes we've seen in capital markets has been around debt. Historically, we were really subject to incredibly high interest rates. If we were looking at debt structures, we often would be in a position where we had to encumber our Bitcoin in order to raise debt. And now we're seeing many new parties coming into this space. We're seeing much more attractive terms starting to be put on the table. And certainly that as well will be good for the industry, good for shareholders, because when we can access lower cost debt, it means we're less dependent on dilutive events. So certainly a lot of movement in the capital market space where publicly traded miners are concerned over the last 9 months. And I'm very optimistic that that's a sign of more positive things to come for all of us.
Awesome.
Thank you, Michael.
We like that.
We do.
I look forward to seeing Bitcoin miners issuing large debt to buy Bitcoin.
You know, we're always following your lead, Michael.
I give you all permission. Fred's up next, and Fred's going to tell us about Bitcoin mining and energy firms and what's going on in the energy industry. Fred, take it away.
Thank you, Michael. It's glad to be here. Appreciate everybody being on today. So as we look at the energy markets today and we think about power and the power companies, I just wanted to share a couple slides. So I will hopefully be able to get this. Sorry, we're just having a little glitch here. So I'm actually going to do this. It should work. Not sure if you guys are seeing my slides at this point or not. Please let me know if you're not. So if we talk about the future of power, you have to think about who have the incentives.
But we're
And
not seeing them.
you're not seeing the slides?
No.
Okay, then I'll just do it the old-fashioned way, I think.
Caitlin, is there some setting that would give him the ability to share his screen that's got to be flipped on or off?
No, it shouldn't be. Fred, you should
You know
just be
what?
able to share
I
your
can just
screen
do this with,
directly.
I can just do this without the slides. That's fine.
We can share those with everyone afterwards.
Yeah, that's perfect. Let's just do that. So I hope now I'm back on the screen. So as we think about the incentives in this business, one of the single largest input costs to Bitcoin mining is energy. And as a miner, you look at our P&Ls, the single largest cost we have, upwards of 66%, maybe even higher in some cases, depending on the economics that a miner has, of our variable costs are energy. And when we think about energy, a lot of people talk about how energy is a scarce resource in this country. And in reality, that's not the case. In this country for the past, and then by that I mean the US, for the past 2 decades, this country has generated and consumed roughly 4 terawatt hours of electricity on a continual basis. And the interesting thing about that is power generation exceeds consumption in this marketplace. We consume less energy than we generate, and a lot of energy gets wasted. As Michael mentioned in the presentation earlier, a lot of energy gets essentially wasted in this country. But the interesting fact is people say that Bitcoin miners are taking energy away from consumers, and that's not the case, because if you look at how energy, the market in the US has developed, industrial use of energy consumption is actually 14% lower today than it was 20 years ago. And more importantly, residential energy consumption is only 2% higher today than it was 20 years ago. And it's growing at about 1% per year. So how do you convince energy companies to invest heavily in renewable energy? They have to have an incentive. They have to have a reason for it. And Bitcoin mining, as many of the previous speakers have mentioned, is that perfect reason for energy companies to deploy more renewable energy and grow their wind farms, grow their solar farms, grow their hydro, and also grow nuclear and also geothermal. So we're big believers in the fact that Bitcoin mining is going to be a huge incentive for power companies to invest more in renewable energy. And we actually believe that power companies will become some of the larger Bitcoin miners over time. Why is that? Well, think about a nuclear plant, for example, that may be operating at 60% of its max capacity. Nuclear plants have a very difficult time raising and lowering power in response to the grid. But if they had Bitcoin mining, if you would, behind the meter, they could regulate their power to the grid by simply turning on or turning off Bitcoin miners. And as we look at the marketplace today, many people feel that they're going to want to just partner with hosting companies. But my personal belief is that really the power companies will over time become the ideal Bitcoin hosting partner for miners like Marathon. We believe that the power companies are going to view this on a global basis, not just in North America, and start entering this market as miners, and we look forward to partnering with many of them in the future. That's really all I wanted to say, Michael, and I'll hand it back to you at this point.
Okay, thanks, Fred. So batting cleanup is Gaurav. So why don't you tell us about the Bitcoin supply chain?
Thank you so much, Michael. I hope everyone can hear me okay. And great to be a part of this panel. So by way of quick introduction, I'm Gaurav Putrani, and I'm the CEO of Prime Blockchain, or Prime Block for short. Quick summary on our company. We are a vertically integrated operation powering full-scale solutions for Bitcoin mining in North America. We are already operating at scale and are approaching about 90 megawatts of installed capacity this month, which translates into around 1 exahash in self-mining and about 2 exahash in deployed capacity for our institutional hosting customers. On the personal side, before joining PrimeBlock, I spent over a decade at Goldman Sachs in the investment banking group, advised on over $300 billion of transactions across energy, semiconductors, and cryptocurrencies, including Coinbase's direct listing. In my role as a critical member of the crypto coverage team at Goldman, I had the privilege to spend time with several companies and investors exploring the Bitcoin and crypto economy over the last several years. Before diving into the specifics around the supply chain, I would like to reiterate some of the points that were made by the panel over the last few minutes, particularly around the overall macro state of the industry as kind of helpful background for thinking about the supply chain constraints in general. So the mining industry, if you were to look at from 2017 to 2020, it was roughly a $3 to $5 billion industry annually. The margins remained pretty attractive throughout the last cycle, albeit with some compression on a year-over-year basis. Now, after the last halving event or the ongoing price cycle, however you want to define that, the industry's size has increased by roughly 4 times, which is about $15 to $20 billion on an annual basis. And I think the substantial increase in the size of this market, combined with the whole China mining ban, has greatly benefited the profitability and margin profile, which sits at about 90% right now, excluding CapEx costs. Now, as one would expect, the dynamic has resulted in more mining companies and more investors who are entering this market and trying to capitalize on the opportunity that is available in this industry. Now, one of the questions that everyone asks is, and it is a very important question, which is the viability of these margins on a go-forward basis. And I think that's where understanding the supply chain becomes somewhat essential. We all know that there's an ongoing global supply chain issue, which is impacting almost every industry. Yet, ironically, some of these supply chain bottlenecks benefit the Bitcoin mining industry, especially the miners who are already running at scale. And I usually break down these scaling and supply chain issues across access to capital markets, obviously capital being extremely important, the semiconductor supply chain, the power infrastructure, shipping and logistics, and then finally the hosting capacity. And a couple of areas that I would definitely like to double click on are the semiconductor supply chain and the ancillary inputs that go into the power infrastructure, if you will. On the semiconductor side, the number of ASICs that get deployed on the network invariably impact the profitability and the profile of the network itself. And with an ever-increasing demand for miners, TSMC and Samsung are not proportionally increasing their fab allocation to Bitcoin mining. And this is because TSMC and Samsung need to serve every other industry that consumes semiconductors, which is pretty much every industry on the planet. More importantly, though, manufacturers of Bitcoin mining machines, they are okay with this constraint, and they are okay with this constraint because there is a price inelasticity of demand. Therefore, manufacturers can quickly increase the price of their machines and not rely on volume for as much growth as they're relying on the price of the machines themselves. And this price inelasticity of demand creates the first rate limiting factor for hash rate growth, and why we think margins will not necessarily get commoditized away in the near to medium term. And we also know from anecdotal evidence that there are many potential Bitcoin miners that have access to power but cannot get their hands on Bitcoin mining machines right now. Moving on to the power infrastructure, as Fred mentioned, there seems to be abundant low-cost power available in North America. What we have observed is that ancillary inputs, such as transformers and cables and wires, are creating a bottleneck in scaling up data center operations. The lead time for some of these ancillary inputs could be several months or even years out, which limits how quickly you can deploy the power infrastructure for a large mining operation. In summary, I would say the key to a successful mining operation would be solving for all the critical inputs at the same time, which includes capital, mining hardware, data center, power infrastructure, logistics, shipping, and hosting. And you're seeing with the new fresh institutional capital, which is entering this ecosystem, understanding these supply chain bottlenecks have become critical. And I think miners who are already running at scale or who have solved these critical supply chain bottlenecks will thrive in the next, call it, year or 2 years till the supply chain problems persist. And thank you everyone for the time, and back to you, Michael.
Excellent. So that was your 8 briefings. Now we're going to get into our analyst Q&A session. And I guess I'd like to invite the panelists that presented to turn their cameras back on. And Caitlin, can you bring Lynn Alden on stage, assuming she's here? She'll be first.
Lynn, you should be able to unmute yourself and talk.
Hello, are you able to hear me?
Yes, we
Yes.
hear you now.
Okay, thanks for hosting this and putting this together. I appreciate the slides. My question is about the potential for co-location with power providers, as actually Fred touched on. Has there been an uptick in the power generation industry, or at least awareness in having dialogue with miners about that going forward? Because obviously that can cut down on transmission losses. It can eliminate duplicate security. Has that been something that's been maybe an uptick in awareness, or not really at this time?
Absolutely. The conversations we've had with 4 of the top 6 power groups in North America, they all now have dedicated teams looking at Bitcoin mining as a load balancer. They have venture teams investing in the space. They have discussions ongoing with hosting providers to essentially build out hosting facilities that they will co-own. So I think you're starting to see this really grow. I would say also internationally, there is a rapidly growing demand for partnerships with miners from power companies in areas where they have no need for extra consumption of power, but they have excess energy, and they want to find ways to monetize the large investments they've made in infrastructure until such time as their consumer space grows large enough to need that power. So I would say absolutely any large power company with assets is looking at better asset utilization, and Bitcoin mining is the perfect thing for them, and it's a great profit enhancer for them.
Thanks, I appreciate the added color.
I could add to that. About 2 years ago, DMG, with one of our partners in the US, we actually deployed some containers to utility companies in the US that have been experimenting with the functionality of curtailing containers to keep the power load up. And we've done some power studies around this, and it's been very positive, the results from it. So I think, as Fred said, you're going to see more utility companies or power generators looking at this as a very effective way to not only manage their loads better, but there's also a financial benefit that normally would be lost to capacitor banks that would chew up this load and just be wasted energy.
Glad to hear that. Thank you. I appreciate that.
Do you have any other questions, Lynn?
I think that covers it from my end. I think that's
Okay.
certainly the headline I'm going to focus on.
Good. Then Nick's up next. Can we promote Nick to the stage?
Nick, you're welcome to unmute yourself.
Hi there. Thanks everyone for putting this together. Just some question on your definition of sustainable, what that means, whether that incorporates carbon offsets, and if so, to what extent?
I don't think that Yeah, actually, it does include carbon offsets, but I don't know the extent to it. Our definition of sustainable is renewable plus nuclear plus carbon offsets. And that's what we get in the surveys.
And do you know if the offsets portion is material within that sustainable category?
No, because the survey that we run just gets us the hash rate, the energy usage, and the sustainability percentage. So we don't break it down, or we don't ask any of our survey recipients to give us more than just those three top level numbers.
Understood. And then lastly, same question as last time, actually. In terms of the extrapolating, I guess it's 33% of hash rate to the global Bitcoin network. You have your 65.9% sustainable for in sample and 55.7% sustainable for the whole Bitcoin network with the extrapolation. Can you talk a little bit about the assumptions made for the out of sample data?
I'd be happy to hook you up with our analyst who will go over them in great detail with you, but he should do it, not me. You could probably just cover it with Taras offline.
Okay, that was all I had. Thank you.
Okay. Next up is Kevin from H.E. Wainwright.
Thanks, Michael, and thanks to all the panelists that presented today. Very informative, great set of topics, and absolutely appreciate the color and having the opportunity to speak with you all. So thank you very much for that. A couple of things. I think one of the big ones is, now I know Jamie's addressed this partially, but I think in general, the community might want to think about how this effort could be accelerated. I think all your firms have done a wonderful job in accumulating Bitcoin, but I think for now, at least from a shareholder's perspective, I don't think they're seeing the benefit of that. And I don't know if it's a messaging situation. I know Ben spoke to a cash flow. I know there are ways to handle it that perhaps could be a little bit better. And I'm wondering if you folks have discussed that amongst yourselves and have any plans.
So I guess I'm trying to follow what's the question?
I'm sorry, Mike, I apologize. The question is with, say, Bitfarms, for instance, 2,500 Bitcoin on the balance sheet, Hut 8, 4,700 Bitcoin on the balance sheet. How are you showing the benefit of hodling for your shareholders? What instrumental ancillary cash flows can you generate?
Yeah, so Kevin, I think as you know, for us, we do have relationships with Genesis and Galaxy that we use a portion of the Bitcoin to generate yield. And I think we're very much in the early days of exploring the art of the possible as far as how can we put our Bitcoin to work without incurring undue risk to that very important Bitcoin that we want on our balance sheet.
Yeah, I would throw in here, although I'm actually taking credit for someone else's great success, maybe Fred. Silvergate Bank just announced $100 million credit line, a revolving credit line that is collateralized largely by Bitcoin, by some cash, but by Bitcoin. So I think the obvious two benefits of holding large sets of Bitcoin are you either borrow against it or you generate yield on it. And some of the miners are starting to generate yield, as Jamie pointed out, and other miners are beginning to set up credit lines and borrow against it. And I think that you'll see in the coming year that business matures. And I think you're going to see definitely in the not too distant time frame a lot more either yield generating options or collateralized Bitcoin loan options. And that would generate a direct advantage.
I'll add to that. to Michael's point, during the last crypto winter, the Bitcoin on our balance sheet, we were able to use to secure a loan and not have to sell down our Bitcoin. And then when we could raise capital, we used it to pay that loan off. So it's absolutely a critical tool in the chest for miners, being able to use that Bitcoin to raise capital.
Okay, maybe a question for Peter, given Texas specificity. The slides you shared, Peter, spoke to what, 23 gigawatts of renewable going and adding 10 over time in Texas, Peter. And I'm wondering what you think the timeline on that is. And I'm also wondering how you'd expect the ERCOT to support the influx of mining expected there. And I guess how you expect ERCOT to balance renewables, wind and solar, which are very temperamental, against regular demand from the influx of Bitcoin mining.
Thanks, Kevin. Good question. So first on the timeline, that 10 gigawatts is expected to come online in the next 5 to 6 years. So it's coming pretty quickly. Like I said, particularly on the solar side. On the ERCOT side of supporting miners, and I said this in my presentation, it's not just miners that are excited, it's actually the ERCOT executives. I mean, they're meeting with miners, they're meeting with, power supply folks, power management folks, and they're figuring out ways in which we can go beyond just controlled load response, ways in which we can really integrate with the grid. And that kind of answers your third question as well on the balance side. I think that it's very unusual for a large energy user to be as flexible as Bitcoin miners are, as cryptocurrency miners are. It just doesn't happen in the industry, in large industry. And so to be able to provide a stable load at a 5 gigawatts in a few years is a very significant amount of power to be using in Texas. So that's just going to provide more stability. And the ERCOT folks are excited about trying to integrate that power into the grid.
Okay, quick question for Romain. I know you spoke to the adoption of Lightning Network, and I think that's great. You offered the Twitter example. I think that's wonderful. But how long do you think it'll be before I'll be able to buy a coffee at Starbucks with Bitcoin?
Well, in San Salvador, it's already happening. So you can actually do it over there. And I think it's going to be very fast at seeing it happen in other countries in the world, and mainly in the US. Again, Twitter is leading the way. More people are getting and receiving tips via Satoshis and the Bitcoin network and the Lightning network. So I think we are going to see it coming way faster than what we think. And I'm sure that technology companies anywhere in the world and in Silicon Valley, in New York, are working on different kind of applications that will use the Lightning network to develop services that will be used by lots of people and more people in the coming months and years.
Yeah, if I would add one other observation, which is the next stage of the rollout of Bitcoin, the network, and Lightning is for those Lightning rails to provide the high-speed network to move stable coins like US dollar stable coins around. And I think people are realizing that what they want to do is send $57 over the Bitcoin network to El Salvador for a 20th of a penny. And so there's a marriage of basically stable currencies or digital currency with the digital asset. And it's highly likely that you'll use the Lightning network to pay for your coffee in dollars before you use the Lightning network to pay for your dollar or your coffee in Satoshis, right? For Bitcoin to spread to 6 billion people, you don't need to buy coffee with Satoshis. You could, in fact, there's a pretty interesting situation going on here, which is 66 countries in the world have dollarized, and we're watching the imminent collapse of another set of countries that I'm not going to name on the call. But if you're following macroeconomics, you can see a number of currencies are collapsing. And when they collapse, they'll dollarize. And when they dollarize, the problem is nobody's got a Visa card that works, because when the banks shut down, the Visa lines and the credit cards shut down in the countries, not to mention the fact that most people didn't have a bank account to start with. So the summary, that's a long-winded way of saying Bitcoin, it supports Lightning. Lightning is spreading the United States dollar to 6 billion people. And the big news here is going to be that the United States dollar spreads everywhere on earth, that the Chinese don't stop it on Lightning rails. And Bitcoin is in that way significant as a monetary network, not as an asset. And that's the reason that El Salvador, they adopted the dollar alongside Bitcoin. They're using one as an asset in a network and the other as a currency. And so Lightning's important to us because A, it takes transaction load off the blockchain, which is a certain benefit to Bitcoin users. But B, it really is firing up the application business. And one of the, you're gonna find this amusing, but the killer application for Bitcoin, the single number one biggest killer application for Bitcoin is US dollar stable coins to 6 billion people on mobile phones. That'll probably be the single big winner. After that, all the other applications like, moving around Satoshis and tipping, and there's a million other cool applications you can build on Lightning. But that entire industry's, on fire, and it's exploding in every direction. No one can keep track of it that much.
I add one other thing, Michael, and that is that today, because of how Bitcoin is taxed, the ability to transact in a stable coin like USDC, for example, obviates the need for tracking every Starbucks transaction you do for tax purposes. You simply have your account with Bitcoin. Once a month, you liquidate whatever you're going to into a stable coin that sits in your account. You spend that stable coin. You have no concerns now anymore about the tax treatment of your coins.
Yeah, I think a lot of us think that there'll be digital currencies like stable coins sitting alongside digital assets like Bitcoin, and we're going to use the assets as collateral for fiat loans and as a savings and store of value. And we'll use the underlying Bitcoin and Lightning as a worldwide global open network that's permissionless and non-custodial. And the stable coins are destined to find their way as the common currency in Nigeria, Argentina, Venezuela, Lebanon, Afghanistan, fill in the blank. If there's 66 countries that are dollarized right now, I think you could probably make a list of 66 more countries that will be dollarized in the next 36 to 60 months. And if I could make money betting on that, I'm trying to figure out what the investment is that you're betting on if you want to bet on the next 66 countries to dollarize. But I guess the bet is Bitcoin, and we're already in it.
Last question for me, Michael. Maybe Fred will want to take the lead on this, but I think it behooves the panel to consider in my mind. I think there's a stigma still associated with nuclear power, even though there's been this emergence of microreactors. And I'm wondering how you might collaborate in changing the nuclear narrative such that it's more widely recognized as green energy.
I think as you look at nuclear power, it's the ultimate sustainable energy because it runs and runs and runs. I think the holy grail is fusion energy because after all, that emulates what the sun does, and it's very clean in how it works as opposed to fission. The other issue really that it's a societal issue, and it has to do with the belief that nuclear is not safe. 70% of the energy produced in France today is nuclear, and France has no compunctions about that. It works. If you look at the primary reason why Europe today is having an energy crisis, it's because they shut down their nuclear energy, thinking that the renewable energy would take up the slack. And now you have not enough wind in the North Sea. You have a drought in Northern Europe affecting hydroelectrical power capacity in Norway and Sweden, and you have major issues. And the UK is becoming a huge importer now. And the big business in Europe is laying electrical cable so countries can sell electricity to each other. If Germany hadn't shut down their nuclear, and other countries hadn't shut down their nuclear in the same way that France has maintained it, they wouldn't have this issue. So as you talk to nuclear energy producers in the US today, people like Exelon, for example, who I believe have 22 nuclear reactors, most of those reactors are operating at fairly low capacity levels and could operate at much more efficient levels if they had better base load like Bitcoin. I think the other thing is that these smaller nuclear, call them almost fuel cell systems, are going to become much more prevalent as we look at the shift in the energy markets from centralized power generation to generation at the edge. One of the key things today that many communities are looking at is if you live in the 17 southwestern states in the US, for example, you have abundant solar power, you can do community level solar power with battery backup and run 60 to 70% of your electrical needs that way and become independent from the grid. And it allows the communities to generate a revenue source because they can also use Bitcoin mining at that community level at small scale very efficiently. So I believe personally that we're going to see community level power at the renewable side. We're going to see it at the fuel cell side, which is primarily hydrogen driven. And we're also going to start seeing these SMR, small nuclear systems, that are deployed in a couple of 40-foot containers, totally self-contained. And we may potentially see those in places where there's less of a community stigma against nuclear power. But it is the future. And I believe FERC is actually licensing one of the first reactors of that scale in 2024.
Okay. Hey, Kevin, thank you.
Thank you, Michael.
We appreciate it. Lucas, you're up next. Can we bring Lucas to the stage?
Lucas, you're welcome to unmute yourself.
Hey, good evening, everyone. Thank you very much for the panel. Super informative. I wanted to touch really quickly on two things. First on China, can you give us an update as to Bitcoin mining over there? Is it what's roughly the hash rate? Would you say this transition is completed? And if not, kind of how much more is left to go? Thank you very much.
I'll go ahead and touch base on the question. That's a really hard one to answer as we don't have any firm data coming out of China. And obviously the people who are in China still operating are trying to hide their presence. What we have seen is that there is a large number of Chinese operators who are continuing to hold on to their equipment in storage in China, hoping for this regulatory situation in China to pass and be transitory. I don't think that is going to happen. I don't think that's going to be the situation. So like what you'll see is over time, as people become less patient, as Bitcoin price increases and Bitcoin mining profitability increases, the relative cost of holding on to all of that equipment in storage for longer and longer periods of time is going to increase. And that's going to force them and incentivize them to deploy that equipment a lot faster. So I think that with the relative timelines that we have in North America to build out infrastructure, we're probably well into 2022 before we see all of this equipment deployed, and could be well into 2023 before all of the supply chain is sorted out.
Anybody
Lucas,
else have opinions on China? Fred?
Yeah, Lucas, the other thing I'd say is that the Chinese government they're not doing this in a half-hearted way. So they started by shutting down large-scale miners. They have shut down all commerce related to Bitcoin mining. They are shutting down pools. So the largest Ethereum pool in the world got shut down. We're expecting to see all of the Bitcoin mining pools operating out of China shut down effectively. They're blocking IP addresses. They're out hunting after VPNs that people are using. They are going into heavy industrial sites. The social scoring mechanism has been updated so that you can now report somebody who you think is Bitcoin mining or who is dealing in crypto, buying, selling, trading. They're going after every aspect of this. So I think the number I heard quoted by somebody was that China had recouped about 5 to 10 exahash and then it disappeared again. And so, I wouldn't be surprised if there's less than 2 exahash actually hashing in China today of Bitcoin.
Very
Ethereum's
helpful.
another topic.
Thank you. Thank you very much.
And Lucas, I would also say one of the inputs that we've been getting is as the period for hydropower. So China really goes between hydropower and coal. As the period for hydropower comes to an end by the end of, call it this month or early November, there's not going to be a transition from hydropower to coal the same way it had happened before. So whatever residual mining there is, you're probably not going to see a bunch of that come online because of that energy transition from hydro to coal.
Got it. Super. My second question is on immersion cooling. I had a big press release earlier today. Any views on the panel, kind of where the market share could sit, call it 12 months from now, where it holds the greatest promise? Would really appreciate the panel's perspective on that.
Sure, I'm happy to start. We're doing immersion as well in Texas. We're building our own immersion tech at large scale as well, 200 megawatts. I think it's hard to estimate how quickly it's going to be adopted. I think there's some folks that are still not convinced. There's some folks that still have legacy systems that they are using that they've already built the infrastructure for. But we certainly are expecting better efficiency for the machines and better lifespan. Machines will last longer. So I think that it's going to continue to be. It's still early days for immersion at large scale, but I think it's going to continue to grow and, be within 24 months. I think it's going to be the de facto mining standard for large scale systems, whether it's in the exact form that it comes out, this year in, or whether it's going to evolve. I think it's too early to say, but I think it's going to be around for a long time.
Yeah, I'll just add to what Peter said on immersion. We've been doing it for a while at DMG, planning on scaling it up, but we went and hired a third-party engineering firm to help us test immersion, because there's a lot of talk about the efficiency gains, but there's not a lot of data on it. We all believe that it'll take the heat off better than air cooled. And so we did a study. It took a few months where we metered the power on the same miners, the same hash rate, the same firmware in air cooled, and then we moved it into immersion cooled. And we found across the board an 18% savings in power. And so, when you look at the discussion at the beginning of this presentation by Michael about what's going on in power and efficiency and what's just happened in the chips, when you start adding in other technologies, more efficient PSUs is another way of savings. Immersion cooling is another way of savings. There's a lot of potential in immersion cooling. Immersion cooling has been around in traditional data centers for a while. But I think the real savings of immersion cooling are much higher in crypto mining and high performance computing than traditional data centers. I think that you're going to see a natural progression to this technology. It takes a little bit on the engineering side, and there's a little bit more CapEx, but the ROI is very strong when you're looking at saving 80% of your power.
Okay, Lucas, you have any final question?
Thank you very much. Super. Really appreciate the panel.
Okay, thank you. Hey, Mark Palmer, you're up next.
Yes, thank you very much. And thanks very much for the presentation. My question is really one more about the political realm. The fact that we continue to hear members of Congress making statements regarding the environmental impact of Bitcoin mining that just don't mesh with a 42 times increase in energy efficiency over the last 8 years. You've had a few of these sessions now. Have you seen any progress on that front? And what is being done to bring this information to members of Congress and to further educate them, to close that gap between their view of things and reality?
I'll give a quick response and then I'll let the rest of the team answer that. I think we reached peak ESG hysteria right around the time of the Chinese crackdown with Mr. Musk's tweet. And I think that that concern has decreased measurably, progressively, and kind of linearly since then to this day. And if you, I looked at all the senatorial hearings and the congressional hearings discussing crypto, and I parsed every word by every senator, every congressman, and every regulator in the past 3 months. And the only thing I found surprising was the depth of conviction and support for crypto and the lack of criticism of Bitcoin mining, which I didn't really see that much. I think you might find 1 or 2 quotes from one senator at some point, but if you look at the congressional hearings with Gensler testifying a few weeks ago, the entire thing was pretty much occupied with the discussion of, we like crypto, you need to help grow the industry. Can you move faster and provide regulatory clarity? Right. And the regulator is saying we're working on it and we're doing the appropriate thing at the speed which we can do it. So I don't really see a strong political opposition or anybody in that regard. And I think that in fact, for the most part, the story has moved on, and now people are really focused upon all of the good things that Bitcoin is bringing to the nation. Other people on the panel, what do you guys think?
I mean, I would just say, going back to what Sheldon said in his presentation, where he's like, I own Bitcoin, my kids own Bitcoin, my parents don't. I think it's also a generational thing. And I think, particularly when you look at the US Senate and there's folks, who are in the politicians who are in the twilight of their careers, let's say, they're not going to be as familiar with cryptocurrency and Bitcoin than younger politicians. I mean, Ted Cruz said that at the Texas blockchain conference. He's like, there's 5 of us who get Bitcoin in the Senate. The other 95 still need to be educated. So I think that's interesting. What we've seen in Dickens County, and I know other miners in Texas have seen local politicians, particularly in rural communities where there's not a lot of jobs, really embracing the industry and really welcoming it, because it is a way to bring, an exciting technology and, the future of the internet to parts of the world that are often ignored and that have had massive job losses and massive migration out. I mean, I'm sure Jamie's seen the same thing in Alberta. And so we've had a really great welcome in Dickens County, and have been embraced by the community. I know the guys at Ride, the same thing in Rockdale. So I think that's interesting. And I think that kind of, momentum will flow upwards to other levels of government, as Bitcoin just keeps getting adopted and keeps growing in momentum.
I'd add that Senator Daines from Montana in 2018 in a congressional hearing, actually for the Senate Energy Commission, I think it was, spoke very articulately about how Bitcoin mining actually helped balance the grid in Montana and how it was going to allow them to save jobs. Our facility in Hardin, Montana, it's about 105 megawatts, has created jobs for members of the Crow Nation. It creates revenues for the tribe through licensing of energy sources, and has made us, essentially, we've been able to take a power plant that was essentially shut down and bring it back to life, jobs and all, for the community. So I think there's, to Peter's point, there are congressional members in these more rural areas, smaller states by population, where really they see the benefits that Bitcoin can bring, and they're becoming educated. And as Peter mentioned, Ted Cruz did a pretty amazing job of articulating what's going on in Texas in a very good way for the industry.
He's an Albertan.
Maybe
Thank you very much.
Add one more comment as a Canadian company interacting with the U.S. government. Not many people know this, but DMG, we applied for a U.S. export permit of power, and we did this about 2 years ago. It was granted. It took a little bit, but when you apply for a U.S. export permit, it is public information and people can give comments on it. We had a large environmental group that gave many comments to the U.S. Department of Energy, which we answered all those comments. But the point, just to be quick, is that the U.S. Department of Energy looked at our application, looked at the power we were interested in exporting out of the U.S., out of Washington State into British Columbia, and found that we would have no impact on the power system, and we would not be interrupting flows within Washington State or other parts of the U.S., and that there's excess power that's available and ready to be exported out of the U.S. So just another way to think about this, as you've heard, Michael talk about the overall survey.
Mark, do you have any other questions?
That's it for me, but thank you very much.
Thank you for joining us. Deepak is up next.
Oh, hi guys. Good evening. Can you hear me okay?
Yeah, we hear you fine.
Thank you for inviting me to join the panel and speak. I've covered crypto miners since 2017, early 2018, and it's great to see the industry organize and educate investors, and not just investors, but government and other enterprises on how the industry is maturing. What I found most interesting, Michael, was your comment on how the network is getting more efficient naturally through the improvement of mining equipment and through the halving cycles that come. The question I have for the miners is how do you manage your CapEx with that improving efficiency over the next several years? And how far ahead do you look when you're planning your CapEx spend? Because, margins are one thing for investors, but what I learned through the last crypto winter cycle, whether or not there's another one, is that return on invested capital is just as important, if not more, over the long run. So I just wanted to know how you look at that. And if it's not an answer for today, it's certainly something I'll be asking you in the coming months and years as I start resuming coverage again in this sector.
I can share from Marathon's perspective, because our model tends to be different from many of the other miners. We don't invest any of our capital in hosting facilities or owning power generation. 100% of our CapEx goes to miners, which gives us a return on capital of over 2 times, which is very unique in the industry, I think. So we focus all our CapEx on really miners and generating revenue through miners. It's also critical, the timing of the purchases. If you get to the heart of your question, it's when in the cycle are you deploying more capacity? When aren't you? When is the technology transition? Somebody previously, I think it was Lucas, mentioned the comment regarding immersion. There may very well be a next generation of mining ASIC technology that gets you an increase energy efficiency in excess of 18% that could still be air cooled. And in that way, you don't have to do all the modifications required to move towards immersion mining, because it's not an air or immersion. Immersion is much more expensive and requires a very different design of your facilities. So those of us who are air cooled today, converting to immersion has a cost to it. Those who are deploying immersion de novo have a benefit in that area. But I think at the end of the day, we're going to see a technology enhancement over time that's going to drive power consumption down. It's going to drive the cooling requirements down, and it's going to drive the CapEx for mining down. But I think that's yet to be seen in the future. But I think the key is really investing in what produces the most return on assets, and that is mining equipment as opposed to infrastructure.
Anybody else want to tackle that question?
Jamie,
Yeah.
you want me to go?
I was just going to chime in with, I think one of the big differences, as Michael alluded to, between the last cycle and this cycle is we expect the equipment that we're buying now to be profitable through the halving. We're not going to see the exponential rate of equipment becoming obsolete that we did historically, Deepak, which is certainly to the benefit of miners and how we deploy capital. And then I think we all view the depreciation schedule of miners a bit differently, but we can leave that for another day.
I would just add, kind of following up from Fred and Jamie, on our model used to be the same as Fred's. We used to believe that 100% capital should go into machines. We now believe that as we scale, we need to own the infrastructure to be able to thrive long term, and particularly to be able to survive the downturns. This is a cyclical industry, and when margins get tight, you want to pay as low as you can for power and be the last one to have to turn off any machines post a halving event. So that's kind of how we view deploying capital. It's a balance. I think I agree with Fred as well. It's about timing. It's about timing the cycle. It's about timing, the right, buying the right machines. We say buy the right machines for the right price at the right time. And I think part of that is also buying counter-cyclically, trying not to get caught up in the kind of FOMO cycles. We saw earlier this year, April cost of machines went up well above $100 a terahash. If you deployed a lot of capital during that period, you'd be kicking yourself right now. And then I think that the other important piece, Deepak, is to get machines operational as quick as you can if you're going to be paying top dollar for them. You don't want to pay a lot for machines and then have them wait 6, 8, 9 months for it. If you're going to do that, you've got to do what a lot of us have done and put in orders that are predictable, that are at a good cost, a good price down the way. So that's kind of our approach, is really an approach, what we call smart growth, focus on ROI for the rigs.
Okay, Deepak, you have a follow-up?
Yeah, I do. It's more of a comment, and the answers are very helpful. I think it may be something for the council to consider, and it's less of an issue today than it was in 2018, but Gaurav might remember this. One of the things that I saw in 2018 were a lot of new miners coming to market, pitching to investors, giving forecasts with flat hash rates. And we all know that hash rate growth tends to go up steadily over time, and Bitcoin remains volatile, which makes margins volatile. And so this kind of created a moral hazard in 2018. And when crypto winter came along, investors kind of looked at some of these lesser quality players and said, hey, where did your margins go? And you told me that your margins were going to continue to grow. I'm surprised because I still see that to a limited extent today. It's much less, much more limited than it was in 2018. But I've still seen some new miners coming to market with very little transparency around their forecasts and future hash rate growth. Some of the recent large IPOs have been much more responsible with that, which I think is great. But just a comment for the council that expectations on hash rate growth and transparency around forecasts, I think, is really important to create an enduring investor base, because investors don't like surprises. They understand that the industry is cyclical and there may be downturns, and they can stick with quality companies to invest through it. But I think just some greater transparency around that can help the industry. That's my own experience as an analyst covering the sector through the cycle. And again, thanks again. It's great to be a participant in the council, and great to see the industry organize and communicate the messages much better and more clearly to investors.
Thank you, Deepak. Okay, so is Joseph here? Because he'd be batting cleanup.
I'm batting cleanup. It's good to see everybody. Thank you, Michael, for the invite. Some really great presentations, really enlightening. So thank you very much. And thank you for the opportunity to ask us a couple questions. I had a few, but a couple percolated to the top on the question list just here recently. And Fred, you mentioned in a previous follow-up to one of the questions that a lot of the big utilities now have Bitcoin teams in place. And just, I would love to hear from the group, both in the US and Canada, what that might mean for miners moving forward in terms of opportunities to, perhaps co-locate, find power, and other things to kind of opportunistically grow. If we think about, megawatts, perhaps becoming scarcer a bit more over time as capital flows into the sector. And, it does sound like the utilities are responding to this opportunity and the symbiotic relationship. So love to hear from the group on that.
Just to give a little bit of a clarification. So the power companies have teams looking at this, but there are actually power companies today who are building joint ventures with hosting providers where the power company will do a certain percentage of self-mining on that infrastructure, and the rest will be open to partnering with mining companies. In some of these cases, the power companies are actually investing in the infrastructure themselves. So they're looking to be essentially a third-party hosting provider together with self-mining. So you could imagine power company XYZ competing with a Riot or a Core, essentially, with the benefit to the power company that they control the single largest input cost. So I fully expect to see a plethora of hosting providers and a plethora of hosting capacity come online over the next 24, 36 months in this country and internationally as well.
Yeah, I think Brad's right on this, just from our experience working with a few utilities and power generators. The one thing, though, that they don't understand is crypto mining. So they understand power generation, power distribution, and there's a lot of technical challenges in power engineering, but they don't understand, wallets, pools, machinery, networking, all these things that hosters and Bitcoin miners or self miners do know. And so the conversations we've had with utilities and power generators is always around how do we work together? We're not experts in what you do. You're not an expert in what we do traditionally. How do we marry ourselves together and work together on large scale deployments over the next little while? So we're finding that a lot of the power generators out there are really interested in working with well-known reputable miners and trying to figure out how to partner up with them and take advantage of what crypto mining can do for their power assets.
Do you have any follow-ups?
Just one, Michael. Thank you. We kind of heard, a lot of your slides, Michael, were compelling on the energy efficiency and the benefits that Bitcoin mining is bringing to kind of for a lot of aspects of the grid and infrastructure. And it does sound like there's some awareness building. I was wondering if there's a more formal effort underway, and perhaps teaming with utilities or whatever to kind of get the word out in a bigger way relative to kind of changing the narrative around, the kind of high level perception that might be in place right now about Bitcoin mining.
I think Bitcoin's pretty decentralized, and there's thousands and thousands of partnerships that are popping up all the time. From my perspective, the political debate and the mainstream media discussion has shifted away from the entire ESG issue for Bitcoin mining, and now it's focused upon regulation of stable coins and regulatory clarity about what constitutes a security on a security token, and crypto lending, and then DeFi. And most of the interest in the media and the political realm and the regulatory realm is all surrounding all of that, which is non-Bitcoin related stuff. And so I think we've largely, won that debate with any serious investor or serious politician. So I'm not so concerned that that's really an issue. I think that really at this point, the question is really which energy company is going to make $10 billion by getting into Bitcoin mining aggressively, and will a company like Exelon decide they want to quadruple their market cap by being serious, or will Bitcoin miners simply will energy companies sell trace amounts of energy to Bitcoin miners rather than get in the business? So, and it's the same situation in all other parts of the industry. The question is, are you going to buy $1 billion of it to make $1 billion, or are you going to buy $10 billion of it to make $10 billion? Do you want to be Coinbase? Do you want to watch Coinbase? Do you want to be a Bitcoin miner, or do you want to be bought up by a Bitcoin miner? Well, I've talked to a lot of the energy companies, and I said, you probably ought to do this because it's worth 50 cents a kilowatt hour, and you've got infinite electricity, which is worth nothing to you. And maybe you ought to do it because you're trading at 1 times revenue and you're regulated. But if you don't do it, that's okay, because I think the Bitcoin miners will probably just buy you in short order, because they're going to be trading at 20 or 30 times revenue. And when they start trading at 30 times revenue on $1 billion or $2 billion in revenue, they'll probably just reverse merge and buy up whatever energy company they want. So I don't really think this is so much about, is Bitcoin mining using clean energy anymore? I really think it's a question of who's going to win and who's going to lose and who's going to play the game. And everybody has to make that decision for themselves.
Thanks, Michael. You may be able to make that analogy into the capital markets one day as well. And maybe we'll start with energy and it may migrate over there as well one day. We'll see. Thanks, everybody. Much appreciated.
Dan, you've snuck into our view and I'm very impressed. I feel like I have to give you a chance to ask a question because you got into my attic somehow.
I had to have some fun here. So thanks for the loan, by the way. I appreciate the Bitcoin. So we've talked a lot about decentralization, and we've talked a lot about China. But the question that I'm always thinking about is, why is it that there's so many miners, the equipment itself, that comes from China? Does that effectively make the industry a little bit dependent on China? And maybe I'm coming from the vantage point of a U.S. citizen, and I get that. And I have nothing against China, by the way. But do you guys see 5 years from now that we're going to be as dependent as we are currently to what is in effect an oligopoly?
Dan, I'm happy to
jump
sorry,
in
go
on
ahead, Michael.
The Chinese have been in charge of Bitcoin mining historically, but the China mining ban is just one of many trends that's driving Bitcoin mining out of China and decentralizing its power. I think historically the Chinese are a bit more aggressive on speculation, and they're willing to invest the money into chip development that a company like Intel just isn't willing to do, or at least wasn't willing to do in the past, into a Bitcoin mining chip specifically. As we see the institutionalization of Bitcoin mining take place, and as all these Bitcoin mining companies start to expand aggressively in the United States and also want to work with US counterparties, I think we're going to start to see a lot of emergence of different companies and more traditional computational companies emerging as mining manufacturers. What we saw recently with the silicon shortage last year was TSMC was out of production capacity space at the 7 nanometer level. They made production capacity space available at their 5 nanometer level, but the traditional companies like Intel, AMD, Apple, and so forth, they weren't able to utilize the 5 nanometer because it takes them years to develop that chip and go through the marketing and all sorts of the bureaucratic process, where Bitmain was able to utilize that 5 nanometer level right away because there's a direct return on investment to developing that chip. If it has certain operating specs, it generates a certain revenue. And so just in 10 years, we've gone from being on PCs to leading the cutting edge of computing industry. And that direct economic incentive to creating a chip is going to incentivize the traditional computational companies like Intel and others in order to develop their own chips. So I think we're going to see a lot of American manufacturers come out, and it's going to be driving not only the chip levels forward, but also the process nodes, and could be opening up whole new kinds of chip level design. The architecture for chips right now has been going on since the 70s. So that's also ripe for disruption.
Yeah, and Fred, I think you're going to see at least 4 new US-based mining manufacturers come to market in 2022. And by 2024, you will start seeing what happened in the PC industry, which is the specialization. You'll have ASIC vendors, which will be merchant silicon vendors. You'll have a standardized PCI type bus. You'll have hot swappable standards for hash boards. You'll have systems designed specifically for immersion. You'll have other systems for air-cooled, and you'll see more of the traditional server industry happen. But today, the electronics industry is very centered in Asia and China because of a historical low manufacturing cost. But that is switching with what's going on in China today. TSMC is investing $100 billion in new chip plants, and they're not in China, and they're not necessarily in Taiwan either. You're seeing Intel build its first new chip plants in a long time in this country. And I think you're going to start seeing nearshoring in Mexico with a lot more electronics manufacturing here. But at the end of the day, iPhones are predominantly made in China. Most servers are made in China. Most PCs and laptops are made in China today. And that's going to take, a decade to transition if it does.
Thank you. Thanks, everybody. I'd like to see all my friends up on my big screen.
Thanks. And with that, I think we'll declare our sessions to the end. Thank you for everybody in the audience that joined us today and staying with us for the 2 hours. And I want to thank all my panelists for your presentations and all our answers. And thanks to everybody for supporting Bitcoin. We'll look forward to seeing you all again in 12 weeks. And until then, all the best.